All right, hello everyone. Okay, welcome to day 15 of Project Options Cashflow. Okay, this is I'm Possible Terrence over here, and glad to have all of you joining me for this evening session. Okay, all right. If you're in right now together with me, drop a note, say hi. All right, hi Muru, hi Jacqueline, hi Anthony. All right, anyone else who's joining us? All right, drop a note, let me know, say hi. Okay, great. Hi Maureen, hi Josephine. All right, hi Christine. Okay, great. Everyone's joining me from the other Zoom meeting we've just finished earlier. All right. Okay, now great. Now, so we're going to do something really interesting and special today. So we are on Project Options Cashflow for day 15. Today, we are covering another one of my favorite strategies over here as an option seller. So today, we're going to cover the strategy called sell put spreads. Okay, all right. So today, we're going to cover sell put spreads. Okay, now, so we have prepared something really special for all of you. So if you're joining us right now, okay, we have a summary. Okay, so I'm going to send out a summary for today's covering, all right, and learning points from today's strategy itself. Okay, so if you'd like to have access and a copy of the summary itself, which we have prepared, okay, just do us a simple favor, all right, just click on the share button for the video on Facebook. All right, and just share out the videos so we are able to reach and really benefit as much people who are interested in investing, more so with options as well, okay, to have a clearer understanding of the benefits of different option strategies. Okay, so click on the share button over here. Okay, anyone who has shared out the videos, okay, what we'll do is we'll turn around, okay, we'll go to your post itself after the session ends, okay, and we'll leave the download link. All right, we'll leave the download link for the summary file, okay, in your shared post. Okay, all right, thank you very much. Okay, now, so go ahead, share the videos out. Okay, so we'll leave the summary in the comment section of your shared video post over here. Okay, after the session is over. Okay, all right. Let me get my PowerPoints ready and going. Okay, all right, now, so today, welcome to Impossible Investors Project Options Cashflow. All right, so today we're going to begin on day 15 of our 30 days challenge. And just as a standard disclaimer, investing presents a risk of loss. So any trades, anything we suggest during the session, you would have to assess your own risk before taking up any trades that are being suggested. Okay, all right, now. So today we're going to go into cash flow strategies. In fact, the last one of this particular series. Okay, tomorrow onwards, we'll go into the portfolio building strategy series. Okay, so day 15, sell put spreads. Okay, or it could also be known as what we call an insured put seller. Okay, an insured put seller. All right, now, so we'll cover the basics. Okay, and then how do you best use the strategy? Okay, the different moving parts, the pros and the cons to the strategy, and choosing the correct strike and expiry date. Okay, and of course, we'll go through some trades that we would have and able to look at tonight as well. Okay, all right, now, so again, if you have just joined us over here or didn't catch it earlier, just click on the share button of the videos, okay, and share it out, okay, and we will come over. My team will come over after the session is over and just leave the links for the summary sheet that we have done for today's session as a strategy. Okay, and we'll post it up in your shared post over here after the session. Okay, all right, great. Thank you very much. Now, selling put spreads. So how do we break down this strategy? Okay, now, so earlier in last Friday session, which is day 12, we covered the idea of selling a put option. Okay, so we talked about, what's great about selling put options and what, should we look at over here when we're doing a strategy like that. Okay, all right. And, different things that you should be looking out at. Now, so today we're going to go into put spreads. And what's the difference? Okay, so the difference is really the fact that, you're selling a put option. That's still happening, right? Which means you're still collecting money. Okay, but instead of doing it naked, okay, what you're going to turn around and do today, right, is you're actually going to turn around, okay, and after selling the put option, okay, you're just going to turn around, okay, and also buy a lower strike put option. Okay, which means when I say a lower strike, I'm taking into reference, okay, the strike that you have sold over here. Okay, right now, so you sell a put option as your first objective. Okay, you get some money for that, you collect some money. Okay, and then after that, okay, you will turn around, okay, and pay a lesser amount, okay, to buy a lower strike put option. Okay, now, so for this entire trade, what do you get then? Okay, what you get over here is you get to collect. You still collect, okay, because you're selling something that costs more. So you still collect over here, right? And you collect what we call the offsetted amount. Okay, so you're going to collect what we call the offsetted amount over here, yeah, okay, for the entire trade. Now, so let's go and quickly look at, a possible trade design and structure. Okay, so let's say we're looking at BAC, okay, and we're looking at the 19th of June expiry. Okay, 19th of June expiry. Okay, now, so let's say you're looking to sell the 23 put option strike. Okay, the 23 put option strike, which is now, right on the dot. Okay, right on the dot. Okay, now, so if you're going to do this the aggressive way and you're going to sell the 23 put option, okay, you might actually say, oh, Terence, if BAC shares were to go below 23, I might be in some trouble. All right, and Terence, I don't really want to own those shares as well. All right, now, so how can I protect myself from having to actually own those shares or to cough up the money to own those shares over here? Now, what you could do is, like we said earlier, you turn around, okay, and spend a little bit of money, okay, and you buy what we call a lower strike put option. Okay, now, so when you do that over here, for example, you turn around to the $22 put option, okay, and you execute a buy order on that. Okay, what you have done is you have effectively converted your naked put, which you are selling, into a spread. Okay, now, so what a spread offers is this. A spread offers what we call a maximum loss on the trade. Okay, now, it has a maximum loss because, okay, you have committed to your customer, right, to buying the stock when you sell the put option at 23 strike. Okay, now, so when you turn around and buy the 22 put, you have actually bought yourself a right to sell the stock, the same stock, at the same expiry date, or at $22. Okay, so that means for this particular stock right now, effectively, okay, you get, right, the actions, right, you get both the actions. You get to buy at 23, okay, and you also get to sell at 22, right, should your customer choose to do so, and should you eventually choose to do so for the 22 put as well. All right, okay, so you realize you have opposing actions over here, right, for both the option strikes. Okay, now, so when you have opposing actions, basically, it ends up with different end results. Okay, so if one is going to make you buy the share, that means the other action is probably going to make you sell the share after that. Now, so in the diagram, okay, this is how it's going to look like. Okay, we have the stock sitting right here now. Okay, the sell put option is over here. So effectively, we want the stock to go up. So both options will expire worthless. Okay, but if it doesn't, okay, we have our break-even point at 22.58, right, based on the premiums that we collected earlier. Okay, and anything above that, okay, it's going to be a profit. Okay, and this is our margin for error, all right, from where the stock is to our break-even point and our maximum loss. Okay, so if the stock goes down, yes, we're going to lose money, right? But the perk of such a strategy is we have what we call defined loss. Okay, we have a defined loss over here on this strategy. Okay, so you achieve what we call a max loss effect, which is based on the difference, okay, based on the difference between the strike prices of your put options. Okay, all right. Now, so if you have a sell 23 put, that means you have an obligation to buy the stock at 23. Okay, and if you buy the 22 put, you have the choice to sell your stock at 22. So think about the stock. If you buy a stock at 23 and then you sell it off at 22, what's your loss going to be? Right, you got that right. The loss is going to be $1 on the share, right? And that's why this strategy brings about, all right, a max loss situation over here. Okay, now, and unlike, you know, your cut losses when you do it with stocks where you have to worry about gaps and things like that, okay, when you structure a put spread over here as an option strategy, what you really get, okay, what you really get is you get a max loss that you have designed and capped from the very beginning of the trade. Okay, is this clear, everyone? All right, if it's clear, can you just type a comment clear in the chat box over here? All right, let me know, all right, that you understand this very clearly. Okay, and after that, I'll move on from here. Okay, all right, so let me know that you understand this very clearly over here. Okay, great. So Christine is getting it. How about the others? Okay, we'll wait for a couple more before I move ahead. I just want to make sure everybody who's joining us, all right, it's more than capable of, you know, getting a good comprehension of what we want, what we are doing today. Okay. All right, give me a minute. My websites are slowing down at the moment, so it's just jumping back and forth as I'm trying to get around my screen. Okay, great. Thanks very much, then. All right, now, so just want to catch a quick glimpse over here, all right, because I do have some questions asking on this. So yes, if you're joining us right now in the session and you have not clicked on the share button on the videos out, all right, so we have prepared, you know, a short summary poster on selling put spreads and covering all the different important points for today's session, right? So if you want to grab a copy of this, all right, do make sure you click on the share button for the videos, right, and help us to share out the video, right? And we would post the download link for this, all right, on your shared post over here after the session ends. Okay, all right. Now, just wanted to show you that before we go ahead because some of you are asking. Okay, all right. Now, so that's one way of selling put spread. The conservative way of selling a put spread is the same stock sitting now at just below 23. Okay, we could go out there and sell a 21 put, okay, which could pay us around 56 cents over here as a seller. Okay, you could pay us 56 cents as a seller. And then we could turn around. We could turn around after that and buy the $20 put option. Okay, so when we do that, we turn around and buy the $20 put option. We have to pay up about 36 cents over here. Right, so this trade would have left us with a 20-cent credit. Okay, all right, and by now you realize if the strike prices are 21 and 20 as a pair, right, our max loss on this trade is going to be $1. All right, $1. Right, so if you're collecting 20 cents upfront on $1, right, effectively this trade is structured up to yield a 20% return. All right, a 20% return. Okay, as you can see over here, it has about 30 days to expiry. So we're looking at 20% returns in about a month, right? A month time from now, okay? All right, now, so that will also mean that our break-even price is gonna be the sell strike, which is 21, right? Minus the premiums we're collecting, all right, which is 20 cents. So that will put us at $20.80, $20.80. Now, so this is how it's gonna look like. The stock is sitting over here. this time we're selling the 21 put, so we're starting below the current stock price. So we have a buffer that is already sitting here, right? And when it crosses below the red line, we still have a buffer because we collected 20 cents. So our break-even price is at 20.80. Okay, now, so anything below anything above 20.80 is going to be a profit. Okay, anything below that, right, it's going to bring us a loss. Okay, but our losses are capped at $1, right, when the stock eventually breaches both lines. Okay, so when the stock breaches both lines, that's where we achieve our max loss on the trade. We close it, we walk away, all right, and then you decide what you want to do again after that. Okay, now, so this is how traders will probably deal with such a strategy. Okay, they would like to sell the put options via a put spread because they want the margin for error if you do it in a conservative manner, right? And they also want to tag up a max loss scenario for the way they do this, okay, and go about collecting cash flow, right? And if they're wrong, then basically what they're doing is they take the loss and they walk away, right? Now, so in this case, their loss is actually not the entire $1, all right, but the loss is the 80 cents, right, after lessing the 20 cents that we collected upfront. Okay, right now, so Wing Kai, all right, Wing Kai, your question over here, right? So Wing Kai has a question for us. So Wing Kai's question is the conservative approach considered out of the money or in the money? Okay, now just think of it in a simple manner. When we talk about options, I'm just going to write it out on the screen. Okay. Now, when anyone tells you that the option is in the money, okay, when it's in the money, that means there is a claim value attached to the option. Okay. Now, so when people say it's out of the money, simply means that there is no claim value attached. Okay. Now, so looking at this right now, the stock is sitting at 22.95. Okay, 22.95. Okay. The customer has the right. Okay, the customer has the right to sell the stock to us, all right, at $21. Okay, now, so the customer can sell it at $21, but the stock is right now still above that. So, Wing Kai, let me ask you this question. Would you say that there's any claim value at the moment? Right, because the scenario looks like that now. If you buy the stock, you have to buy at the market price of $22.95. Okay, $22.95. Okay, you have to pay that price to buy it. And if you get to sell it to us, okay, all right, us the option seller, right, you can only sell it to me, for example, for $21. Okay, so will you do that? Will you buy a share for $22.95 and then turn around and sell it to me for $21? All right, Wing Kai? Think about it again, all right? Okay, I just asked the question, all right? Would you pay $22.95 to buy a share and then immediately sell it to someone else for $21? Okay, now, because if you do that, okay, if you do that with a stock, okay, you're looking at a loss on the stock immediately, just from that transaction. Yeah, okay, yes, you got it. All right, Wing Kai, you got it. Okay, now, so if you're looking at the exact situation right now, okay, if this is happening, that means this $21 put option, all right, it's actually called out of the money. Okay, out of the money. Okay, so this is actually called out of the money because you realize that there is no claim value attached to it. Okay, right now, let's go back to the aggressive approach so we can clarify your doubts. Now, for this one, where we went with the aggressive approach, okay, I'm going to ask you the same question right now. Okay, would you buy the stock at $22.95? Okay, same question to you. Okay, would you buy the stock at $22.95 now and immediately sell it for $23? If you can do it immediately, okay, that means you can do it immediately right now. Will you do it? And would you be able to make money? Okay, for the aggressive approach. Okay, all right, now, so if we buy the stock at $22.95 and we immediately turn around, okay, and sell it over here for $23, okay, there is actually a profit to be made. A profit of not a lot, but there's still a profit of 5 cents over here. Okay, all right, now, so this 5 cents is where, yes, all right, Wing Kai, you got it. Okay, so this 5 cents is where we are talking about the part of this claim value over here. Okay, so because there's a claim value, if you should take action immediately, okay, that option is basically called in the money. Okay, now if you want to make it simpler as well, any option, okay, that means any line that you're drawing across over here, okay, if this line happens to be above the current stock price, okay, then it's going to be in the money. Okay, any line that starts off below, right, it's basically out of the money. Okay, now this is simplifying everything in a nutshell over here. Okay, Wing Guy, all right. Yes, Wing Guy, assuming no transaction cost, of course, all right. Okay, now, so let's answer Javon's question over here. Javon is asking, at expiry, if the stock price is between $21 to $20, right? That means she's basically asking if the stock price is trading somewhere in the middle, all right? Okay, somewhere in the middle over here. Okay, what's going to happen? Okay, now, so what's going to happen is if you do not do anything with it, that means if you let both options expire, okay, you would have an obligation that kicked in. Okay, that means you have an obligation to buy the stock, right, for $21, which has kicked in. And because you didn't do anything about it, right, you will be delivered the underlying share, which is BAC over here, right? So you would have to take up ownership of BAC shares at $21, which will be put into your account before next Monday. Okay, do understand, they will not do it immediately after option expires because the brokerage house needs to do some accounting, but you will start to see the position actually appear in your account before trading resumes on Monday. Okay, all right, now, so anywhere in between, there's two options for you. You could pay the market value for the 21 put and get it out of your trading platform and your trading account. Okay, so in that way, then you just accept the loss on the trade. Okay, or two, take assignment of the stock and then on Monday, decide if you want to keep the stock or you want to sell off the stock for losses or profits. It all depends. Yeah, all right. Okay, Javon, I hope I addressed that question as well. Okay. All right, now, so coming back over here, how do we use the strategy? Same thing as well, all right? We would have to be bullish, okay, bullish on the long term as well as short term, it's possible. Okay, all right, but of course, it'll be more practical if we, it'll be more practical if we start to do this on growth stocks or value stocks or hot stocks over here. Okay, now, of course, event-driven bullishness, for example, during this period, okay, during this period where we have COVID crisis, you'll probably look at companies that benefit hugely from, the COVID stay-home period. So, of course, we all see how Zoom stock flew off the charts, okay, and then we also see companies like software companies, all right, that benefits from this entire period as well. We also saw, companies like Action Blizzard, was it, all right, and EA Sports, all right, benefit from this as well, right? You even see like, fitness companies like Peloton, all right, benefit greatly from this period as well. And you'll be surprised, even this Russell 2000 stock called Teladoc, right, which surged up greatly during this period. So Teladoc is basically, online doctor prescription and, consultation service, right, where in America, people can't go to the clinics. So they would, make use of this particular service offered by this company over here, right, to see a doctor digitally, right, and have their prescriptions and then go pick up their medicines after that. Okay, all right, now, so product launches, of course, for us, it's very popular, for your, how do you say this? Right now, it'll probably be Tesla, all right? Back then, we'll probably have the iPhones, right? So product launches over here on the hottest and latest products in the markets. Breakout patterns, so you would have, your channels, all right? And then your breakouts, right? Breakout patterns over here, right? And after we break out, we had some consolidation, so we had some support levels. And last Thursday, we had the breakdown, right? So, it's just this kind of things. But today, we are looking on the upside over here. Okay, all right, so selling put spread has a slight bullish, right, bias to the strategy. Okay, all right, we have a bullish bias to the strategy. Okay, now next one over here, your bullish flags. Okay, your bullish flags, your ascending triangle, your cup handle. Okay, and then you have, your oscillators over here, for example, your RSI, that means cutting back up, all right? Your stochastics, cutting back up, all right? Your MACD line, cutting back up, okay? Your moving averages line, cutting up, right? These kind of technical indicators over here, right? Now, so you basically sell put options when you are bullish, right? But, okay, if you have doubts, okay, you could also do so, right? Because like Wing Kai suggested earlier, right? If we sell the conservative approaches over here, right, and we pick a sell put strike that's below certain support levels, certain support levels or technical moving averages line supports, right, things like that, right? We could actually add on margins of safety in case we are wrong on our timing, right? That means the stock actually dips a little before it starts climbing up, right? So selling put options will allow us to still profit from that process. Okay, all right. Now remember, during the session, if any of you have questions on the points that I'm explaining over the session, do just leave it in the comments, right? So we'll be able to pick it up, and then of course we'll address the question one by one over here. Okay, now so how much same moving parts over here. These parts don't really change when it comes to options trading. We have to decide what strikes do we want to pick, and that comes from the basis of what's our expectation from the move of the stock. Okay, what's our expiry? Okay, how long do we expect this to happen? And then how much do we want to allocate, which is the number of contracts that you want to trade over here. Okay. Now pros and cons. Okay, now the pros is of course moving on from market opening. Right, moving on from last Friday, the same thing. You could be wrong and still make money. Okay, you have the benefits of time decay. All right, you have margins of error. Okay, if you do it the conservative way, okay, you have a limited loss tagged onto the strategy, right? The day you sell it, okay, you have leverage as well, okay, because earlier last week we talked about selling. Okay, earlier last week we did this, which is to sell a put option outright. Okay, that is what we call a naked put, right? So if you sell naked puts, the margin required from the broker is actually 20% of the sell put strike. Okay, now, so that will be your investment that is required as an option seller, right? But this week we are discussing about, all right, a put spread. Okay, so that involves buying a puts. Okay, and you saw earlier, this creates what we call a max loss scenario, okay, or max loss effect. Okay, and if you have joined us on day 14, okay, day 14, okay, if you have missed any of the earlier chapters, okay, right, the team might flash this on the screen. You could go to our website, impossibleinvestors.com, okay, just look for Project Options Cashflow, right, and enter your emails with us, okay, and our servers will actually start you on day one all over again, okay. So we'll be sending you lessons on a day-by-day basis and let you restart the entire challenge, all right, in 30 days over here, okay, at your own time, at your own pace, yeah, right now. So sorry, back to here, all right, a put spread over here creates a max loss scenario. Okay, so just like the call spread, which we discussed, okay, when you're doing it via a spread, you create a limited loss scenario. So that also becomes, right, the margin that the broker wants from you. Okay, now if I have to really get technical over here, right, the real margin is actually the max loss, right, less the premiums collected. Okay, but you could also just take it simply as the max loss amount of it. Okay, all right, so the margin that the brokers typically require for a put spread is basically the limited loss on the put spreads that you're selling and structure over here. Now, so the cons over here is actually the controlled loss. Okay, now why do I list it as a con? Many of you will think it as a perk, right? But the whole idea of a con on this is basically down on the fact that you might end up over trading on your account. All right, okay, now because many of you may start off selling put options, especially put spreads, and then you get overzealous, you get carried away over here. You may end up with 30 weeks, 40 weeks, right? Even sometimes 50 weeks, which is almost a year, right? Where you just keep selling these put options and they just keep expiring worthless for you, right? Okay, and what happens is as you get more and more confident, right? Just like any traders out there, you will tend to start increasing on your position size. and you start to neglect on what we call the risk management over here, right? And that's something we emphasize a lot in my I'm Possible Investors community, right? If you want to sell options, actually the biggest aspect to being successful, right? It's always down to risk management, position sizing, okay? Because if you don't do that, okay, you could literally wipe out your entire account, right? Think about this, right? Back in subprime period, right, which is, you know, almost 12 years ago now, right? We have ever seen, you know, AIG as an insurance company, right, reaching near bankruptcy over here, right? Of course, before they were bailed out. But can you imagine if they were not bailed out, right? They would have to declare bankruptcy, right? But if this is your trading account, the only person that can bail you out is yourself. Yeah, all right. Okay, now, so are you ready with more, you know, capital that you want to dump it in, right? But, you know, if you do this right, then you don't have to worry about it. Okay, now, so the controlled loss, which minimizes the deposit requirements, could actually end up as a con for you, right? If you don't know how to manage this well. Yeah, okay, because of the over trading component. Okay, all right. Now, so having said that, okay, now let's look at some trades over here. Okay, so let's go over to the trading platform and look at some trades over here. Give me a minute while I get my trading platform up. Okay, I've lost it on my screen, so I need to find it. Okay, sorry, give me a minute. Okay, meanwhile, while you're waiting over here, all right, if you have any questions, all right, as usual, all right, do feel free to type it out in the chat box, all right, so I could address them and help your understanding get clearer in a session like that. Okay, great. Now, so let me get on and hop onto my trading platform right now. Okay, so you would be seeing my trading platform and my screen right now in front of you. Okay, so of course we have the S&P on another sell-off day. So as per my Facebook post over here, we are expecting markets to go into kind of, I couldn't call this a correction phase, but I'll call it more of a consolidation phase right now, because the breakout move has obviously cracked. The breakout move has obviously cracked. So we go back into the battle zone right now, where the bulls and the bears are going to fight each other out. And that's really going to be between the 2,715 point level to about the 3,000 point level, which we broke below again today. Okay. Now, so during those periods, you know, you look for bullish trades when it hits the bottom of this range, and then you will look for bearish trades when it goes near back to the top. So until a breakout happens again, you know, this is pretty much the trading phase that we'll see. Now, so going back to put spreads over here, let's say you pick out a stock that benefits during this period from COVID. So let's take Peloton, right? So on Monday last week, which is June 8th, Peloton dropped by about $1, right? And if you're looking for a weekly put option, right, let's look at what's possible as a trade. So you could actually pick out what we call a $40 put option, right? If you're conservative, right, you could pick out a $40 put option and sell it. Okay, and the broker signals that you could get around 24 cents for this sell. Okay, all right, now, and after that, it's really deciding which one you want to buy over here. Right now, so your strikes and your choices are limited by the brokerage platform, because that's what the exchange offers to traders. Right now, as you can see, these are the choices. So let's say if we combine it together with the 37, right? So let's do the 37 over here, right? So the platform suggests that we would have to pay about 6 cents for this. So the entire combo right now that we have on our screen, right, would be done for a sale of 24 cents, right? And then a purchase of 6 cents over here. So remember, as a put spread seller, we only get to keep the offsetted amount. So we only get to keep the offsetted amount. So we are only really looking at 18 cents credit for this trade. Okay, so we look to keep about 18 cents on this trade, which brings about a $3 loss. Okay, so we're looking at 18 cents on $3. Let's have a look. 0.18 divided by 3. So that brings about 6% over here. Still pretty good, all right, for, like a week, all right? This was a 1 week trade over here on Peloton, okay? Now, so of course, we move forward day by day over here, right? So on the 9th, right, it's loading right now. Oh, Peloton shot up by $3, right? So this is what you get from momentum stocks, or what we call the hot play right now. They would have a day off, right? And then, markets will pick them back up immediately tomorrow. They might have an off day again. So, that's how it waffles around. Now, so the third day, Wednesday, 47.11, it drops off 50 cents, right? And then Thursday, when the market sold off, right? So when the entire market sold off, it sold off too, right? But it only did like 2%, right? So many of the, fundamentally strong stocks were dropping 8 to 10%. But this momentum stock literally only dropped 2%, right? So it dropped $1, right? And even after the crash, the stock was around 46, where our sell put strike was still sitting at 40. So this clearly tells you that you are right on track. Okay, you're right on track right now, and you could just let the options expire. Okay, you could just let the options expire, right? So come Friday. All right, Peloton jumps up again to 47, right? So when the market closes, Peloton shares last traded price was $47. So our $40 put strike would expire worthless together with the 37 put strike. So the 18 cents that you collected on Monday is entirely yours. Okay, the 18 cents that you collected on Monday would then be entirely yours. Okay, so this is how option sellers would benefit. All right, if you are doing a put spread strategy. You define your risk, okay? You catch the loss that you're willing to accept. Make sure that the premiums bring about a decent ROI on the entire trade. Okay, once you've calculated that out, you basically weigh the risk versus the returns. And if you're happy with that, go ahead, place your orders, and then track it on a day-to-day basis. Or on Friday, just make sure that everything is fine, and that the options are scheduled, all right, and looks to expire worthless over here. Okay. All right. Any questions on the Peloton historical example so far? All right. If there isn't, then we'll go ahead and look at some possible, trade setups for today, maybe. Okay, give me a minute. Let me see if I can do some settings on my platform without killing it. All right, okay now, so I hope it's clearer now. Okay, so I hope the screen is much clearer now. Okay, now, so once again, just a last reminder over here. There are more of you who are joining me right now in this session. So you have missed out my earlier announcement where we have a summary done up for those of you who would like to pick up important points of the strategy for today, which is put spreads. So if you'd like to pick up a copy of the summary, okay, just click on the share button for the video, all right, and our team will go onto your shared post over here, all right, on your profile after the session ends, okay, and we'll put up the downloadable link to the file, all right, after the end of the session, and you could go ahead and download the file after that, okay, all right, so remember to click the share button, all right, so we'll be able to reach out to more people, all right, and let more people benefit from the idea of selling options over here as a strategy. Okay, now onwards to today's trading opportunity. Okay, now, so let me quickly bring up a trading bot. Okay, all right, now, so what you see on my screen right now is a trading bot, okay, that our community members will get when they join us, okay, and they could also opt to continue to use it after that if they like it. Now, so all I need to do is to go to the bot, all right, and tell the bot today to show me all option trade ideas. Okay, so when I tell the bot what I want for today, it's going to give me a suggestion list, okay, of good stocks, all right, good fundamentally strong stocks that I could look for some options to sell for today's trading over here. Right now, so they are all great stocks. They are all big companies. All right. Let's say I'm favoring more towards HPQ, for example. All right. So I'm going to click on HPQ over here. All right. And it's going to give me the suggested trade for today. All right. And coincidentally, all right, it suggests to me a put spread trade. Okay. So, the bot tells me what it's great to trade out there. So the bot says that, we can look at a put spread trade that expires on the 26th of June, right, for a 15/13 put spread. So that means we're looking at a $2 loss, okay, for this trade structure, a 15/13 put spread, and you could aim to collect about a 12 cents credit. Okay, so this trade will bring about 4.17% in 11 days, okay, on an annualized rate of 152% over here, right? That's pretty great. Okay, that's a pretty good thing over here, right now. So what do we mean when we say this? 6.25% max loss over here, right now. That's where our algorithm has gone all the way backwards for the last 10 years, 15 years, right, and really test out, right, based on where HPQ is trading today, right, and based on where we're selling this put spread, all right, the put strike effectively. Okay, there is about a 6% chance that by this expiry date, HPQ stock price would actually fall by that much, okay, to get this trade into a losing position. Okay, right now. So that's what it means over here. So not by the brokerage data, not by the brokerage platform data, but from real HPQ trading prices that has occurred over the last 10 to 15 years over here. Right now. So that's how detailed we are when we look for great trades. Okay, and those students as well as non-students with our community, right? Do share with your friends about option selling as a strategy. Get them to look at it if they've not done so, right? If they've already done so, right, they would also be able to greatly benefit, all right, from our structure and our designs. Okay, and have a look at the bot and what it brings to the ease of trading right now. Effectively, we have trades at our fingertips. Now, so let's get to the trading platform. All right, let's hunt down this trade and have a real look at it. So we're looking at 26th of June expiry. All right, so today's markets. So one of the reasons why I like to pick, to do the Project Options Cashflow at 9 p.m., all right, it's really because the markets are open. So a lot of times when we run examples over here, all right, we could actually see live live trades happening and the opportunities actually exist right now. Okay, so we have HPQ trading at $15.99 at the moment. All right, it's down a further 30 cents today. All right, so the bot suggested 26th of June expiry. Okay, so that's for 11 days from now. Okay, so 11 days from now. So let's take a look. So 15 put suggests about anywhere from 32 to 46 cents. All right, so if I click on the sell button, all right, and then it combines it with a 13 strike, all right, which if we base on the last done price, it's somewhere around 5, all right, but let's see what the broker suggests over here. All right, so the broker suggests that we could, pocket somewhere in the middle, all right, perhaps, I think it's aiming maybe about 38 cents, all right, and then paying about 5 cents. Okay, and that's where you would see the broker suggested price came out at somewhere around 33 cents over here, right? So you could clearly see the broker suggests that we could get this trade done or place the order at around 33 cents, all right? So if you sell it today, you're looking at a trade that brings about a $2 max loss, all right, and a 33-cent credit upfront. Okay, a 33-cent credit upfront. Now, so this trade over here, if we calculate it based on the deposit that the brokers would want from us for this trade, which is $2, right? That's actually a 16.5% ROI, right? So it's greatly increased from what we saw earlier, right? Because market has fallen further, right? So if we get this trade filled for 32 cents or 33 cents today, we are looking at about 16% return in about 2 weeks from now. Okay, what's our risk? Our risk would start if HPQ were to fall below $15 by the 26th of June. Okay, by the 26th of June. Okay, so that would be the risk that we're looking at. The biggest risk that we'll look at on this trade is if HPQ goes even below $13 put, right, by 26th of June. Okay, so everything is already mapped out. Everything is very clear. As long as the stock price stays above 15, everything is fine. Okay, if it starts going below 15, right, losses starts to occur, right, anywhere from 1 cent all the way to the maximum of 1.99. Okay, and then if it goes below 13 strike as well, that's where we hit the max loss of $2. And if it goes even below that, all the way to bankruptcy, all you lose is $2. Okay, all right, now, so this is one trade that was being suggested by our trading bot over here, right, our IMP trading bot. So, yep, I hope it benefits you over here, right? So that's what I want to cover from today's session, actually, all right? Now, so is there anyone with any questions on sell put spread as a strategy, right, before we wrap up today's session? Anyone with particular questions? All right, this is the time to start posting it up. Okay, I think we have time for a couple of questions over here before we draw the session to a close. Anyone with questions? Oh, Zen, sorry, I missed your question. Okay, let me address Wing Kai's question first. It might be a bit too technical. How do we compute the probability of profits? Okay, now there are two ways to do this. Okay, there are two ways to do this. I'll show you the simpler way first. Okay, and then I'll go back to quickly discuss how we do it as per what you saw on the board just now. Okay, all right, now, so on the brokerage platform over here, you could actually set one of the details. For example, I'm just going to change this on my screen right now. Okay, you could change it to show you, all right, what the brokers would call over here. All right, sorry, I have it on my screen. Okay, probability of in the money. Right, so what it's effectively telling you over here is if you sell the 15 put strike, it has a 33% probability that, you know, the HPQ stock price will actually trade below this put option strike. Okay, so that's one way on the brokerage platform to calculate the probability of the option. All right, and I do know that, you know, a lot of trainers actually use this as a guideline to pick out strike prices that you would sell as well. There's no wrong in that. Okay, I believe it works well most of the time. Okay, but you would need to have your own criteria set in there as well, right? Because if you constantly do this and you don't have a good trade risk management over here, everything can still fail when you just simply bank it on probabilities. Right now, I will really have to tell you that because, you know, on my initial days over here as an option seller, this was something that I delved on and I did and I tested as well. So, you know, doing this could bring you long-term profits for a really long time. And then it could start getting you very complacent, right? And to heavily rely on these statistics. And when it fails, you know, it can really fail you pretty ugly after that. Yeah, okay, so that's why, you know, I learned to build my own criteria on top of that as well, right? Which is now inculcated or built into our trading board. So that gives me a more assured, you know, decision-making process over here. Yeah, okay, Wenkai. Now, so using our board, like I said earlier, we basically track HPQ as a stock, right, for weekly price movements, week to week over here, right, and, you know, seeing what kind of behavior HPQ as a stock possessed over here, right, and then we start to calculate, okay, from now to next week, all right, what are the chances of it falling by another $1 plus to get below the strike price that we're selling? Yeah, okay, so you realize it's a much more thought out process, right, than just statistics over here that the broker platform uses instead. Okay, right, so Zen's question, I didn't get quite what will happen. Okay, I didn't get quite what will happen if the price for HPQ stays at 14 on expiry. Okay, Zen, so we are doing now the 15 and the 13. Okay, all right, now let me bring the order back up. So we are selling the 15 and we are buying the 13 over here. Okay, now, so what you're saying right now is if it is at 14 on expiry date, okay, what's going to happen? Okay, what's going to happen is you have an obligation to a customer that is kicked in because the stock went below. But you as the customer at 13 put, right, do not possess any right at all because there's no benefit. All right, okay, so there are two choices. You could go to the market, pay the losses in terms of the market premium and close the 15 put, okay, or you could be ready to take assignment of HPQ stock at $15 a share over the weekend. Yeah, okay, and of course, if you sell it back off at $14 on next Monday, okay, assuming that it reopens at $14, then you will be looking at the same $1 loss. Okay, so basically you're looking at $1 loss over here, unless you choose to hold on to the stock and then wait for the stock price to recover. Okay, so that's the other way you'll be looking at it. Okay, I hope that clears up your doubt. Next question, Javon. If it falls below $13, we only lose $2. We do not have to buy the stock. Yes, Javon. The risk of assignment only happens when the stock lands in the middle. Okay, in the middle of both strike prices. Okay, when it starts to fall below both options, okay, do understand the options exchange has a rule which says all options that expire with a claim value, or what we call in the money, will be automatically assigned and exercised on option expiry. Okay, so they'll be automatically assigned and exercised on option expiry. Okay, right, so that's the reason why you don't have to buy the stock, because you would have to buy the stock at 15, but your $13 put option will also be activated. That means you have to turn around and sell the stock at 13 after that. Okay, so that's why you will not see any stocks in your account, because you bought it at 15 and you sold it at 13, but you would have seen the $2 loss inside your account over here. Or you will see $200 less in your account capital, right, on Monday, okay, if you did one contract. Okay, all right, Javon, I hope that clears up your doubt as well. Okay, I think that's also the questions that all of you who are joining us today have. Okay, so let me get to my PowerPoint before I close. Okay, tomorrow's topic is going to be an interesting one. Okay, tomorrow we're going to touch on the portfolio building series. Okay, so I'm going to kick off tomorrow's portfolio building series with the topic of selling put options. Okay, so tomorrow we're not just going to talk about selling put options or selling what we call naked put options. Okay, but we are also going to delve on how do we do this called selling ridiculous put options. Okay, selling ridiculous put options, right? And if you're looking to build a portfolio of great stocks as well as generate income and cash flow over here, right, for the long term and for the long run, okay, do not miss out this session that we have planned for tomorrow. Okay, all right, now, so do remember as well, you can still stand to get a hold of the summary sheet, strategy sheet for put spreads that we have prepared. So all you need to do is to click the share button before we end the session today, right? So if you've not done so, do make sure you do it now before we end the session, right? So we'll only post the link in all the shared posts over here that we see after the session once we end it over here, okay? All right, now, so do go ahead, click on the share buttons over here, all right, and help us share it out, yeah? I'll just answer Zen's question before we wrap it up. So Zen is asking right now, following the previous question, that means that I need to have enough capital to buy the stock at 15, or I could close the put option by buying back a $15 put option. Yes, Zen, that's what you do, right? But if you choose to buy back the $15 put option, you would have to go back to the brokerage platform, right, and check out what's the bid-ask market price for this particular option on that day of Friday itself. So you basically have to close it off before market closes in America at 4 a.m. in the morning. Okay, all right. Now, so as long as you close it up, all right, you would have to incur the losses between what you sell earlier and what you pay to buy right now. Okay, but you will not be obligated to purchase the shares. Okay, all right, then I think that clears up the question that you have. Okay, now thank you very much for those of you who are joining us once again on day 15. Tomorrow we go to day 16 and we start learning how to use some of the strategies that we've discussed so far, right, to build a portfolio for yourselves. Okay, all right, now, so those of you who have always been looking about information on how you can sell put options as a viable strategy to build portfolio, right, and to create what we call heads I win situation and tails I'm still better off and still a winner kind of situation, right? Stay tuned to tomorrow. Join us tomorrow again at 9 p.m. Singapore time, which is GMT +8 over here, and I'll be here, all right, and I'll catch all of you in tomorrow evening session. This is Terrence Tan. I'm Possible Investor signing off, and I'll see all of you tomorrow. Good night, everyone. Bye-bye. Welcome, Wyman. Bye-bye. All right, welcome, Jabon. Welcome. All right, welcome, Shani. All right, welcome, Anthony. Bye-bye. All right, welcome, Maureen.